This chart shows the recent tech-driven market rally. The S&P 500 is climbing at a pace that has pushed its valuations to precarious, historically high levels. With the index currently trading at a price-to-earnings ratio above 31, deploying new capital into the broader market carries a heavy risk. This graph illustrates the exact threat that creates: sequence of returns risk. If you retire and are forced to sell your assets during a sudden market crash, you permanently destroy the foundation of your portfolio. We can see the S&P 500's steep climb next to the steadier path of defensive dividend funds. During the Great Recession, the S&P 500 lost 51%. In contrast, defensive dividend funds experienced maximum drawdowns of just 16 to 20%. Relying purely on tech-heavy growth indexes at these valuations shifts your retirement onto market timing, a vulnerability that high-quality dividends mitigate. To survive the inflated valuations of 2026, you need a way to generate cash flow without being forced to sell your principal shares. That creates a tightrope walk. You have to balance the need for immediate, high-yield cash today against the need for inflation-beating dividend growth tomorrow. And then there is a third, heavily ignored variable: tax location. Where you hold an asset impacts how much cash you actually get to keep. The perfect dividend stock does not exist. There is only the correct mix of yield, growth, and tax efficiency for your specific life stage. The first approach is the yield anchor strategy. This relies on defensive funds like SCHD, or legacy dividend kings, companies like Johnson & Johnson and Coca-Cola that have increased their payouts for over 50 years. These assets provide reliable starting yields of 3 to 4% and carry significantly lower volatility when the market shakes. But by excluding high-growth technology stocks, this conservative strategy severely underperforms the broader market during major bull runs. The alternative is the dividend growth strategy. ETFs like VIG lean heavily into technology and financial services to prioritize momentum over immediate payout. This bar chart compares performance. Over 5 years, a $1,000 investment in VIG grew to $1,627, outpacing the $1,478 from SCHD. The catch is the starting yield. VIG yields under 2. It usually signals declining corporate earnings or a balance sheet buried under unmanageable debt. Eventually, the math catches up. The company slashes the dividend to survive, and a massive sell-off instantly destroys your principal investment. A yield that far exceeds the market average often warns of fundamental instability, signaling the company's capital is at a breaking point. The choice of account matters just as much as the choice of stock. Ignoring the tax location of your assets can create a silent leak that drains thousands from your retirement fund every single year. Dividends from U.S. corporations are normally classified as qualified. This means they are taxed at preferential capital gains rates, typically around 15%. But if you place those same qualified stocks inside a traditional IRA, the IRS strips away their special tax status entirely. On $50,000 in dividends, a taxable account's 15% rate costs $7,500. In a traditional IRA, 24% ordinary rates cost $12,000. Add the 3.8% net investment income tax for high earners, and compounding this difference over 20 years creates a staggering $170,000 loss. Poor asset location effectively doubles your tax burden, wiping out decades of careful dividend compounding in the process. Your exact timeline to retirement should dictate your entire dividend philosophy. This flowchart maps the initial decision. Your strategy splits based on whether you are more than 10 years away or less than 5. Accumulators with 10 or more years must focus on total growth, using ETFs like VIG, accepting a lower income today to secure inflation-beating dividend growth tomorrow. Retirees less than 5 years out shift to immediate income needs with SCHD. You sacrifice total market return to gain psychological safety and a reliable cash flow during market crashes. Your timeline strictly dictates whether you are buying income for today or buying income for tomorrow. The final, critical step is execution, placing your chosen assets into the right buckets across your portfolio. You have to separate high-yield, ordinary dividend payers, like real estate investment trusts, from your qualified payers. This diagram shows exactly how to sort them. Ordinary dividend payers belong strictly in tax-advantaged accounts, like IRAs, to shield them from high annual taxes. Qualified dividend payers, like SCHD and the Kings, belong in taxable accounts to preserve their 15% discount rate. Running this dual account strategy requires active portfolio rebalancing and strict organizational discipline. Optimizing your dividend strategy secures your cash flow, and it prevents a 40% tax drag from ruining your retirement.